Hello, today I am going to teach you about 8 to chart pattern. The video is presented by the Forex official channel, so I request you to join us first. Let's go to the video. Number 1, head shoulders pattern. The first pattern on our list is known as the head shoulders pattern. This pattern is a reversal pattern, where a larger peak, the head, is accompanied by 2 smaller peaks to either side of it, the shoulders. The pattern presents itself in bullish regular and bearish inverse forms, where the bullish head shoulders is an upside down variant of the head shoulders, as can be seen in the example below. 2 smaller shoulders accompany a larger head. After the second shoulder is completed, a breakout to the upside can be expected. Traders generally use the distance between the top, or in the inverse pattern, bottom of the head and the neckline to determine a target for this pattern. Number 2, double top and bottom pattern. The double top pattern is a common reversal pattern that consists of 2 roughly equally sized peaks in close proximity. It shows buyer exhaustion as the price fails to break a price level twice in a row. After the second peak forms, the price often breaks down and reverses into an opposite trend. A double bottom pattern is exactly opposite of the double top, a bullish reversal pattern suggesting seller exhaustion, consisting of 2 roughly equally sized bottoms in close proximity. The above chart on the right shows an example of a double bottom, resulting in a move higher. Number 3, rounding top and bottom pattern. The rounding top and bottom patterns are reversal patterns, but are very easy to identify. The chart below shows an example of a rounded bottom where a downtrend slowly weakens until it starts trending up again. Traders generally start buying as the downtrend weakens and will start adding to their positions when price starts trending up. Number 4, flag pattern. Flag patterns are a continuation pattern that signals a period of consolidation within a strong trend. They tend to be a perfect time to get into new positions, to take advantage of the trend. Generally speaking, an explosive move eventually slows down and enters a brief consolidation before resuming the trend. Flag patterns can be bullish and bearish depending on the direction of the overarching trend. The below charts are examples of bullish left and bearish right flags. Number 5, cup handle pattern. This bullish continuation pattern shows a period of pause before the overarching trend continues. The first part of the pattern, the cup, looks similar to a rounding bottom, while the second part appears similar to a bullish flag. After the cup is completely formed, the handle forms and the uptrend continues. The below chart shows an example of this in practice, though ideally, the bottom is more rounded than the one in this example. Number 6, wedge pattern. Wedge formations are a type of reversal pattern that often forms when the price pushes into resistance or support. It consists of 2 trend lines in a formation that tightens as the pattern progresses. There are 2 types of wedges, rising bearish and falling bullish. The below charts are examples of the falling left and rising right wedge. Generally break out in the opposite direction of the wedge itself, that is, a falling wedge generally breaks out to the upside, and a rising wedge generally breaks out to the downside. Generally speaking, the falling wedge is more common in a bullish market, and a rising wedge is more common in a bearish market. Number 7, descending triangle pattern. Ascending triangles are a bullish continuation pattern that signals consolidation within a strong trend. They tend to be a good time to get into new positions, to take advantage of the trend. Generally speaking, an explosive move slows down, enters a consolidation, where equal highs and a higher lows result into compression and eventually expansion. The below chart is an example of an ascending triangle pattern and the breakout that follows. Number 8, descending triangle pattern. Contrary to the ascending triangle, descending triangles are a bearish continuation pattern, a consolidation within a strong trend. Descending triangles are generally a good time to take on new positions, to take advantage of the trend. Generally speaking, an explosive move slows down and enters a consolidation, where equal lows and lower highs result in compression and eventually continuation lower. The below chart is an example of a descending triangle pattern and the breakdown that follows. Okay, remember what we taught you today and stay with us in the future. Good luck to all of you. Then we're going. Goodbye.